Hi, hello, welcome everyone to this panel discussion, Navigating Risk for Digital Assets Investors. I'm Alessia Monarca, Crypto Risk Officer of Community, and I'd like to personally welcome you to today's event. Let me start off with a short introduction about the Crypto Risk Office. We are a non-for-profit community with the objective of raising awareness around the importance of implementing good risk management practices in the digital assets and crypto ecosystem. So everyone is welcome to join us, get in touch with me, message me on LinkedIn, and I will be very happy to show you around the Crypto Risk Office ecosystem. Without any further ado, I will introduce today's moderator, Francesco Mocchi-Sismondi, founder of Not Your Money, which is an educational and advisory platform to help individuals and busy professionals embrace digital assets with security and confidence. So just in terms of housekeeping, we are aiming to turn these into an interactive session. So feel free to to post your question, which will be answered at the end of the session during the Q&A. So let me welcome Francesco. Hi, Francesco.
Hi, Alessia. Hi. Really excited to be here today and share the stage with a great panel of experts to discuss such an important topic.
Same here. Thank you, Francesco, for hosting this panel. So I'll just leave the screen to you, and I'll add all your panelists. See you later.
Fantastic. So just by means of brief introduction, as we bring all the panelists on stage, as Alessia alluded to, I'm Francesco Mocchi-Sismondi, and the founder of Not Your Money. Before that, as happens, I spent the better part of 20 years in various global banks, Morgan Stanley, HSBC, mainly as an enterprise risk manager, and lately as the head of risk in a crypto asset service provider in Switzerland. Some of you might know, called Swissborg. Now, enough about me and on to the stars of the show. So no particular order, I'm just going to go around, maybe starting with you, Anton Golub. Do you just want to share a few words on yourself, who you are, what you're up to, and then we'll just go around the table.
Yeah, so first, thank you for inviting me, and really a pleasure to be here, and also with so many friendly faces on today's show. About myself, an entrepreneur, a founder, very enthusiastic about the crypto industry, passionate, more than 10 years building companies, from a crypto exchange to a market maker, crypto co-working hub, a DAO. So really excited about everything that's happening in the crypto space, and lovely to be on the show to do today with all of you guys.
Amazing, Anton. Thank you. Jeff, do you want to go next?
Absolutely. Thanks, Francesco. So yeah, Jeff McAllister. I'm at Hex Trust Markets, to be precise. I come from 25 years of TradFi capital markets experience, mostly in the risk space, but also 4 years front office, and I'm looking forward to this discussion. It's an important topic, so it's about time we try and elevate the importance of risk management and investment in risk management across the industry.
Super, thanks, Jeff. Romain, on to you.
Thanks, Francesco. Hi, hello, everyone. So my name is Romain Berry. I'm the Chief Risk Officer of Laser Digital. Laser Digital is the spin-off, the crypto spin-off of Nomura Bank. We headquarter in Zurich, but we have offices in London, Dubai, Abu Dhabi, and Tokyo. So I spent 20 years also in trade finance, working for various banks, HSBC, Citi, JP, and Morgan Stanley. And lately, I was global head of risk for Flow Traders. I've worked in all type of risk type: operational risk, counterparty credit risk, and market risk. And very happy to be here on the panel. Thanks for having me.
Thank you so much. And last but not least, Nicola, welcome.
Thank you for having me, and happy to be here. I'm a partner at Stone Partners. We are a Geneva-based consulting firm doing advisory for blockchain and Web3 related business, and I run the legal and compliance department.
Awesome, great. So we know who's on the screen now. This is a risk panel, but just before we get into the risk subjects, let's take a quick temperature check of the market. The market's up a lot today, as happens in crypto. It's been up for a while, actually, in the crypto markets for the better part of the last year. Anton, do you want to start taking a crack maybe at explaining where we are in the market and maybe running us through what that means and how that translates in terms of new user, new investor adoption from both a retail and institutional perspective?
So the year has started off actually very exciting because we had a monumental event for the crypto industry. In a sense, we got an approval from the US regulator, from the SEC, to launch a spot Bitcoin exchange traded fund, And this was really such a monumental moment, in my view, because it allowed for enormous group of people to invest into crypto assets, or in this particular case into Bitcoin, in a safe, secure, and regulated way, but also very familiar to maybe a lot of people. So you could go to your brokerage account or call your advisor. If you're maybe a retail investor, or if you're a hedge fund, you could invest through your prime broker and deploy some capital into crypto markets, in Bitcoin in particular. And today, we had just recently the disclosures of spot Bitcoin ETF holdings, which are actually a regulatory requirement, where we saw that the world's largest hedge funds, so have some huge names like Millennium, Citadel, Renaissance Technologies, and so on, are all holding spot Bitcoin ETFs. So this is how big of an event it was, that we had billions of dollars of capital coming into Bitcoin through the spot Bitcoin ETF, and the world's largest hedge funds and asset managers, even the investment banks, and banks indirectly for their clients also holding, or investing in deploying capital into Bitcoin. So really, really huge event. And also, just to make it very clear, the Bitcoin ETF was one of the most successful ETF launches in history, if we kind of look at it as in the context of these commodities, investment products, and so on. So really exciting, and the price has, shown that there's actually billions of liquidity coming in. We're now at an all-time high for Bitcoin. Overnight, the price went up. And also we had another, small news actually coming out, that potentially there might be an approval of a spot Ethereum ETF. So the second largest cryptocurrency might as well get its own investment vehicle, so people can, through traditional infrastructure, invest into Ethereum as well. There, to tell you just my opinion, I wouldn't be so bullish as I was with spot Bitcoin ETF. For all of you that have been following me on social media, know I was extremely bullish about Bitcoin ETF. I said this is the big thing happening. But for Ethereum, I would be less bullish, not for the approval, but for the impact and the liquidity coming in. All of us, actually, I also came from traditional finance. I worked at a big hedge fund before as a trader. We know how slow is the adoption of new investments among the traditional finance investors. So just because Ethereum is something very familiar for us now with 10 plus years since the launch of the white paper, for investors, I don't think the impact in terms of liquidity will be the same like it was for Bitcoin. So for Bitcoin, we already have, I think like almost $40 billion liquidity through the spot Bitcoin ETF. I don't think even close to that will even be the spot Ethereum ETFs, just because it takes time for investors to get familiar, to understand the product, understand the underlying, in this case, which is a completely different narrative than Bitcoin. Bitcoin is your digital gold. Ethereum is your world decentralized computer. So, even though I think the markets were very excited about this, and I think the approval is very likely, I think in terms of the actual liquidity coming in, that won't be the case like for Bitcoin. And to be honest, I've been in the crypto space for 10 years. If you wanted to invest into Bitcoin, you had to, if you're a retail investor, you had to open this, accounts with exchanges. I mean, if you tell this to traditional investors, they will say, what account with an exchange? I open an account with my prime broker, and then through the securities account, I trade on exchanges. But we used to open these accounts on exchanges. We had to battle, with these wallets. We had the uncertainty, the counterparty risk, from all of these exchanges, and numerous hacks that have been happening. I think, having spot Bitcoin ETF, with all these traditional layers in between, kind of remove a lot of our uncertainty, a lot of the risks, when it comes to access. So very excited, amazing what's happening, but we are a long way ahead. I mean, just imagine it. After 10 years of my experience in the crypto world, I can say that the victory is that you can invest through your broker into Bitcoin. So Absolutely. It just shows how rare we really are. But because it's a risk panel, want to say, that the risks are still there, they're just different. So the risk is now on the traditional finance side, with all the concentration and single point of failures that you have now, with practically a single custodian for Bitcoin. I'm talking about Bitcoin custody. We also have custodians here on the call, so maybe we can comment there.
Let's get into the risks now. Then let's jump into the subject matter. Then, if you haven't been living under a rock, of course you'll know that with crypto come risks, quite a bit of it. And maybe Jeff, you want to take us through sort of an orienteering tour, sort of a little guide around the risk landscape in crypto before we start diving into the various core components.
Yeah, thanks, Francesco. Happy to. Yeah, a lot of good points there, Anton. I concur. On the risk landscape, we're talking what does the risk landscape look like in the digital asset markets? We've got basically just a small map here, small picture. Basically, I'm looking at it in terms of what are the systemic level risks that investors should be aware of. They're basically low probability but very high impact events, and then we're talking sort of entity level or protocol level, and then I'm looking at project or startup risks, and then asset level, the actual tokens that you're trading, and then of course typical trading considerations as well. At the systemic level, I'd actually put up there one of the big systemic risks is stable coins, and they work well at the moment, but we do have some history of stablecoin failures in the market, and it's important for people to be conscious that they're good while they work, but it's always possible that something could go wrong. Something can go wrong in the traditional financial markets, which impacts the stable coins in the digital asset markets. And we saw that previously with UST, which was part of the Terra Luna system. Of course, that was a bit more of an experimental stablecoin, was algorithmic. And we saw what happened there with $40 billion wiped out of the Terra Luna ecosystem, literally almost overnight. And then with USDC, we saw a little over a year ago that it depegged by as much as, I think it was as much as 12%. So that obviously caused some concern at the time there. So that's something to be conscious of. They're used as more than 50% of transactions on chain. Probably a stable coin is part of the transaction. Then, of course, you've got the risks of major entities falling over. So counterparty risk is very real with a centralized entity in crypto, such as FTX we saw, and many others in 2022 fell over when we saw it was literally a domino effect cascading from the Terra Luna ecosystem crash, which started in May of 22 and culminated in FTX's demise. I think it was late November in 22. So that those risks remain, although I guess a lot of the exchanges have improved their transparency on reserves, which is good. But nonetheless, there are significant financial risks to managing a big centralized financial institution. Aside from that, you can have, it could be a major blockchain failure could happen. We've seen outages of some blockchains have had some outages, only for brief periods of time. Bitcoin has not had any downtime in over 10 years, which is great. And other major risks, state actor risks, sort of could be political, legal, regulatory action could hit the market. And then there's general financial conditions, which affect all markets, commodities, equities, bonds, financial conditions, which are effectively coming from the core monetary system that drives the world today. And then at the entity protocol level, we've got to consider, credit risks and liquidity risks, on-ramp, off-ramp. Investors need to be conscious that your exits could be closed. On-ramp, off-ramp can disappear. We saw also in March last year where Silvergate, Signature Bank and others disappeared literally almost overnight, and it affected the market's impact to off-ramp into fiat. So that's something to be very conscious of. Be aware of your exits at all times. Operational risks, cyber risks, bridges, regulatory exchanges also have their own unique risks embedded in them. For example, some of them have what's known as an auto deleveraging feature, where you might be happy in your perpetual futures position, but they might just automatically unwind your position at a level of their choosing if it suits their system to protect their exchange. So you may have a strategy on, you may be following a long short strategy. A very popular one is to get the carry trade, and you might be long the spot, short the perp. But if you get unwound, all of a sudden you've got the directional risk that you weren't intending to carry. So yeah, other risks include staking risks, of course. If you're participating in staking, slashing lockups, the validator or oracle performance, depending where you're staking, is all something to watch out for. I'm talking about proper staking there, as opposed to, I don't know, what I would call faux staking. Proper staking in my mind is where you're actually supporting the validation of an actual network or participating in an oracle that is performing a real function, as opposed to just locking up tokens for no other reason than locking up tokens and getting a reward. Of course, this ecosystem is full of startups. It's one thing that's very interesting about the industry is that it's an industry full of startups. So the projects that you look at, that you're investing in, when you buy these coins or tokens, you're basically investing in the team that's behind it. Even if it's a DeFi, decentralized project, there's a team behind it. It's worth knowing who's involved in that team and the governance around it. It's worth understanding the community, the investor backing, understanding what's the runway for the project, have the smart contracts being audited and other strategic risks. At the asset level, of course, you've got to consider market risk, volatility of your token. Is it a prime crypto asset like Bitcoin or Ethereum, or is it second, third, fourth, or fifth tier token? What are the tokenomics? And if you're investing in DeFi, you've got to watch out across the board for wash trading. Affects the token liquidity. Is the token liquidity real? And you've got to watch out for slippage, impermanent loss in DeFi protocols. And then, of course, custody solutions. Consider self-custody or regulated custodian as an option. And then general trading risks and practices apply, of course. Beware of FOMO, try and be strategic. What's the strategy behind your trade? Do you have a entry level? Do you have a take profit level in mind? Is there a time horizon for your trade? What events would change your thesis for that trade? What reevaluation points are there, and what things can you put in place to protect your position, such as maybe like trailing stop loss levels and so on. So that's a brief picture, and
Thank you, Jeff.
I'll pause there.
Yeah, very, very comprehensive. Thanks for calling so much out, and gives a very interesting frame, a great cheat sheet, in fact. I hope any of the viewers out there will probably just rip this off and take a screen print of that sort of journey from the macro level to the more detailed level. Very, very helpful, from stable coins, often underestimated, in fact, in terms of the risk they come with, to chains going down, and plenty more to think about. So let's zoom in a little bit, perhaps starting with financial risks. I tend to think that new investors are gravitating into crypto in search of returns. Of course, with higher returns come higher risks, and financial risk is probably the first sort of risk hurdle chapter that any new investor would need to confront. Homa, do you want to maybe guide us through this angle, this bucket of risk, and help investors think about how to get their heads around these aspects?
Sure, with pleasure. So within financial risk, usually we have two types of risk that we're considering. We got market risk and counterparty credit risk. So topic 6 later on will cover counterparty credit risk. So I'm only going to focus on market risk indicators, KRIs, and I would add a little bit of investment risk, obviously. So some of the concepts that we look in crypto are exactly the same in trade finance. The range that we observe are obviously very different. So we can talk about volatility, liquidity, market cap, all these concepts. You can find them in equity, in a lot of traditional financial assets. So how do they apply in crypto? Where when you look at volatility, for instance, it's difficult to only gauge the risk with volatility, because these assets are extremely volatile. As I say, it's the most volatile asset class you can find. So when you look at annualized volatility of 120%, it's the same. It's just like extremely high. And then similarly for the market cap, usually when there's a correlation between the price and the market cap in crypto, under normal market condition, and taking a constant level of supply, then these are good indicator. And as Geoff was saying earlier, how do you divide the universe of token in tier 1, the most liquid, the largest cap, more than 1 billion, and then you have mid cap. So you can slice and dice the whole universe of crypto. There's like 12,000 tokens, I believe, out there. And then when we talk about liquidity risk, it's obviously extremely important. Geoff mentioned the price leakage, and obviously, we can see all these concepts about entering and exiting a position at the right time is extremely important. Obviously, we have so many exchanges, so many venues we can trade on, and can also include all the DeFi venue. Then obviously, it is very important for investor to check the liquidity over the last day, the last week, and ensuring that they can exit a position at the price that they target. Now, one thing which is very specific to crypto is what we call tokenomics. So it's a bit like the fundamental equity research you will find in a normal bank, for instance. So what is tokenomics? So it's a fusion of two words, token and economics, and it refers to the design and the framework governing the distribution and the functionality of tokens within a blockchain ecosystem. So in essence, tokenomics is the study of the economic models behind a crypto currency token or crypto assets. So it encompasses various factors, including the total supply, the future dilution, the initial distribution, the vesting periods, the utility of the token, the burn mechanism, and economic stability. So all these terms are very important. I won't have the time to drill too much into it, but I just want to give some ideas of roughly what is tokenomics and how to use that and how important it is in crypto. So the relationship between the value of a token and its tokenomics behaves in this manner. So if you have a token that has strong utility, limited supply, and a high demand due to its role within a thriving ecosystem or community, its value is likely to be positively impacted. Conversely, if a token has weak utility, an oversaturated supply, and no distinct role or demand within its platform, then its value might be negatively affected. So for instance, let's take an example of a token with a cap supply and regular burn mechanisms. There might be see its value increase as the circulating supply decreases, assuming demand remains constant or slightly increases. So alternatively, a token that rewards holders with additional tokens might create selling pressure if many holders regularly liquidate their rewards. So in summary, tokenomics serve as a foundational blueprint that can guide potential investor to understand the future value trajectory of a token. So it's only one piece of the puzzle. Other factor to consider, would be market sentiment, broader adoption trends, regulatory changes, technological advances can also play, significant roles in determining the token value.
Thank you, Roman. Very, very comprehensive and really important, particularly that one on tokenomics. I think is the different one. I know there's crypto asset data providers like CoinGecko, for instance, have started sharing tokenomics in an open and transparent way, and others following suit. Any other takes on this topic before we move on to the next one? Any different views? Anything you want to add? Anton is shaking his head vertically, so I guess that's a yes.
Yeah, I think like this was an amazing, actually, also contrast the difference between traditional finance and crypto world. And I would like to add to that something that's also highly relevant in the context of, for instance, Ethereum is actually staking. Because I think like there is no equivalent model, the way I know it, where you would in the equity market stake your shares to receive something in return and then basically reduce the circulating supply and reduce the potential sell pressure. So I think like all these economic principles are very interesting, but at the same time, I want to mention, my experience as a market maker, especially kind of if you go down through that coin market cap ranking, actually that most of the impact in the end for the token price, not speculative if it goes up or down, is actually the liquidity. So is liquidity coming in or is liquidity coming out due to sentiment or macro environment? So I think like the way that innovation is kind of going in that space, that you can actually have a reduction of a supply in the available tokens, and how that will play out as you actually have institutional capital coming in, because we might have billions of dollars coming in now through spot Ethereum ETF, but already we are getting hints from the regulator that staking will not be possible. So I think you'll have this, conflicts between the traditional finance and what's possible in the crypto world, the innovation that are actually available. And I think this will be an interesting fusion, which will in the end hopefully result in what the crypto world is offering, and this innovation becomes standard.
Thank you, Anton. Let's move on to so Jeff, you gave us a oh yeah, Jeff, you want to add something as well? Go for it.
If you don't mind, yeah, I mean, it's an interesting one. The liquidity side. I'm wondering if anyone has any sort of insights to share on, identifying wash trading and how relevant that is in the different tokens that are that the investors are looking at. Are there any good tricks to identify the proportion of wash trading in a particular token?
Maybe I can add just really briefly from a market making perspective. The problem wash trading actually comes from two dimensions, actually. One is actually that the exchange wants to fake the activity on its own, trading venue in order to attract further traders to come and trade. On the other side, when it comes to altcoins or kind of coins that are not so popular, they're actually being forced not by the market, but by the exchange itself. Because the exchange actually doesn't want to list a token and then that everybody actually sees that there is no liquidity. There is no organic actually demand. So they put so much pressure on projects to do wash trading. And then I don't want to say that market makers are angels in all of this story, but the market makers and their facilitators, either through side deals or them doing wash trading themselves. But I just want to add how much I have personally seen, how much wash trading damages our industry, both from a perspective of traditional finance, how they view it and highly unprofessional, but also from actually deceiving the industry, what's actually going on with these tokens. Because, wash trading and displaying millions and billions of dollars of volume actually in the end benefits nobody except the exchange, who actually forces that, because And I really want to point out that in this situation, I really see that this is a issue that should be self-regulated, and this should be actually brought forward by the big exchanges to clean up the industry.
Thanks for that.
Just add one thing, and it's connected to this wash trading issue and also to what Roman was saying about the tokenomics. I think that the two topics are deeply correlated, because you need wash trading when the token has not strong utilities, and therefore there is not enough organic demand for people that actually want to use the token for the purposes that the token is meant to be used. And I would stress that when people do their own research about tokens, they need really to check into the tokenomics, meaning not only the basically how the distributed, how much tokens are allocated to the team, how much to other purposes, but really what are the features of the token, what are the utilities provided to the token. And if I'm a token holder, or why should I want to become a token holder? If it's just for speculative purposes, then maybe it doesn't make so much sense. And then you actually need wash trading, because there is no organic demand to sustain that token price.
Thank you, Nicola. So let's move on and sort of cover some of the rest we have to share. So, Jeff, you gave us a great overview with this sort of macro risk picture. Roman, he took us into the financial risk elements. To a degree, Jeff, you already explained how to filter out and look for project-specific risks. But do we want to add a bit more in there? How to go about the due diligence process of selecting one token, one coin, one asset from another? And Nicola, I'd love to have your perspective on this too, from a sort of a licensing, regulatory perspective, and also how regulations are changing this space and making it a bit more onerous for crypto projects to launch themselves. What are the expectations on them as the suppliers, if you like, as the supply side of the market, and on market participants, VASPs, GASPs, or whatever we like to call them in the different markets? So I guess this is one for both of you, Jeff and Nicola, if you want to share as we tackle this question.
Sure. Happy to. I think, yeah, I mean, the regulatory side, maybe Nicola can jump in a bit more, but it is highly relevant, of course. How is the project approaching regulation? Are they embracing or avoiding? And yeah, so maybe Nicola can talk to that a little bit more. But the team in general, I think, yeah, it's really, and I think this comes to maybe a broader challenge for digital asset investors. In the equity world, there's a lot of research, and everyone sort of knows the analysts to go to, or they've got their analysts. People coming into this market, especially if they're coming in new, I think finding information and knowing where to look is probably a significant challenge. And you want to be able to identify, learn what you can about the team, learn what you can about the community, and who's behind it. It's, again, I guess, a lot similar to equity investments, to be honest. But also maybe you need to delve a little bit more into looking at who's the auditor on the smart contracts. Are they relevant? Have they got a good standing? And I think the bigger issue here is for investors coming in is the amount of information and where to find it, and also going back to the tokenomics side, the time that it takes to go into and delve into a project and assess the tokenomics for each retail investor to do that, of course, is a big task.
If I could just probe here a bit, Jeff, I mean, you mentioned before, and I fully agree, that this is an industry of startups. At the end of the day, even the largest players, the oldest projects have only been around for a decade at best. So, whilst they may behave like equity in certain ways. Finding that information is still rather challenging. So I think it'd be useful to sort of dig into that piece a little bit, and maybe you, Nicole, can help us understand how that will change as the expectations and the standards will raise with new inbound regulations.
That will very much change. So the point is that at the moment the situation is quite unregulated. So the issuance of utility tokens is not subject to regulation in most jurisdictions. So in the US, they say every token is a security, so they are trying to apply the regulations that are there for the issuance of securities. Switzerland has been the first country to actually understand that utility tokens were a thing per se, and try to establish some kind of like general understanding about how this should work from a legal point of view. But then the European Union came out with the MiCA regulation, and MiCA dedicates 15 articles only to the issuance and sale of utility tokens. In particular, great importance is attributed to the white paper that has been correctly identified by the European legislator as the cornerstone document for investors to actually kind of like make themselves an idea about the token, how it works, what's the value provided, and so on. So the new European regulation provides for a list of content that needs to be there. And that's already good enough, because at least you can ensure that a lot of information are covered in this document. Also, it's quite interesting how they see the document. So there is obligation for the project to keep the white paper up to date. So if they change this information, they also need to update the white paper. They need to say things in the white paper in a certain way. For instance, there is a clear requirement for the information in the white paper to be clear, not misleading, not to give any like too much color with regards to certain statements, as we saw in the past. So definitely there is a step forward in terms of the European regulatory framework for what it means issuing a token. Of course, it will be a bit more complex from a legal point of view, but actually still I think there is a good balance, because you are not obliged to receive the approval of a regulator. So it's not like a prospectus, for instance, in which you submit it to the regulator and you need to get their approval for the publication, and then you can do your offering. Here is a silent absent procedure. So you notify it to the regulator, and if they say nothing, you can go ahead. And for sure, it will foster transparency and help people make a better understanding of how the token works. Now, of course, this is just one area. The European Union, of course, is a big area. It's not a small one, but still one. And I think European legislator has the ambition of this MiCA regulation being a bit like the GDPR that became an international standard. So we will need to see if this is the case or not. If at the international level, MiCA will be taken as a standard or not.
Thank you, Nicola. Any other takes on any useful tips as to how to scan through the universe of crypto assets and pick out the little gems, and how to sense check and smell test the ones that probably aren't worthwhile pursuing?
Yeah, if I can comment quickly on that, I won't spend too much time. But a lot of these projects are trying to come up with a new technology, right, based on blockchain and some other. So to some extent, to have a technical background definitely helped to go through that. And one of the best advice we can give anyone is invest in what you know and what you understand. So I think Geoff mentioned earlier the FOMO, fear on missing out, a theme which goes through the crypto ecosystem. And I think we need to go back to the fundamentals, which is looking at the white paper, understanding what's the problem that the project is trying to solve. What is the real world application? And obviously looking at the credibility of the team, as you said earlier, a lot of them that will be their first ventures. But still, they need to have the skills to deliver, and then you can follow the roadmap and making sure that they are delivering as they say they would, right? And any delay should be to some extent a yellow flag, right? So, and also to look at the the community and the engagement around that token, and ensuring that there is a transparent channel of communication between the founders, the executive team, and the followers to some extent, or those who hold the tokens. And then finally, whenever you can, obviously look at if the token is already listed, obviously to do any kind of analysis that I've mentioned earlier on market investment risk. And one of our participants kindly added also Bitcoin dominance and some of the factors that are extremely valid and helpful to look at.
Thank you, man. If you're okay, I'd like to move on to the next topic on some of the darker side of risk, so to speak, scams, fraud, cyber. Cyber is big enough a risk topic in TradFi, but I suppose in crypto, as we've seen, it's a one-stop shop. If you have access to private keys, if you can exploit a protocol and exchange, it's money down the drain in an instant. Roman, you want to take this one as you had the mic last, or otherwise any experiences, hints, protection, what to be wary, what to look out for as investors again in staying safe?
So that's a very difficult one. It's like opening the Pandora box. I mean, it's usually the kind of topics that you can see on the headlines of any newspaper. They love this stuff, and they love to trash crypto. And again, to prove a point of, even for some very respected bankers who completely deny the use case of crypto. So obviously there are scams. There's a lot of things to watch out. I've listed about 12. I'm not going to go through all of them. I'm just going to pick some very famous one. And just so explain how it works. So obviously we have the famous Ponzi scheme, right? So we all know that, and it's usually providing, trying to attract investor with offering extremely high yields return. We talked about staking earlier. Once you have something which is in a 14,000% return, then that should ring a bell straight away. You should just walk away. Then you have obviously all the fishy scam, and then you have something which is very basic to some extremely elaborated, and some of them took 6 months. For instance, I'm thinking about one in particular from a country that managed to siphon 19 million out of a company over 6 months, making very legitimate. So these are usually fake website or email and social engineering. So you try to collect a lot of data about the founder. This is, as we said earlier, it's an industry of a startup, and the competition is so fierce that they need to market themselves, who they are, what they do. Therefore, they need to provide, to some extent, a lot of data. And actually, if you look at a protocol or a project or token that doesn't want to to show their face, for instance, or to explain who they are when you perform a due diligence, for instance, that should be a red flag. Then you have the famous pump and dump scheme. So it's typical, traditional market manipulation. You try to gather a lot of momentum about an airdrop, or an ICO, an initial coin offering, the equivalent of an IPO in crypto, and then eventually, once you've collect a lot of interest, then you dump everything and you sell whatever you can, and usually you'll never hear them ever again. And the next one is obviously the fake ICO, which is very similar to that, and that's the reason why it is very important to look at the white paper, because some of the white paper look very legit, but and you think, wow, that looks really amazing. But then if you don't know that this is a copy paste from another white paper, or it's been generated by ChatGPT, God knows, right? So I think it's important to, be very, to criticize and to challenge what is being presented to you. We mentioned the exchange hacks. Obviously, I think one of the, if not the greatest risk in crypto to me is operation risk, and I'm putting all the security, the IT outage and theft and scam in it. I think a lot of the tool that we've seen in trade finance to monitor market risk and counterparty credit risk still applying in crypto. I'm talking about stress test, stop loss, value at risk, party shortfall, exposure limit, concentration limit, liquidity limit, all that definitely apply to crypto. All right, going down the list, malware, obviously. A lot of conversation with counterparties are done on Telegram, Discord, and some of these, alternative platform and channel of communication, which a little bit, difficult to, to track and to see who is going into this group. And the stories I heard is. Some of my friend or colleague get contacted privately one of the participants in some of these chats and then turn out to be a complete scam. And one of the last one I will mention is the famous rug pull. So you have a team of developers creating a new token or a DeFi project. They build a hype and then suddenly withdraw all liquidity, leaving investor with worthless tokens. So I can't go the list is long. Unfortunately, there's a lot of it, and I think to me it's all down to common sense, right? I think and trust, which is very difficult to find, obviously, in crypto and DeFi even more. But at some point, listen to your guts, do your due diligence, try to form a conviction about the project, try to be enthusiastic about what you read, and understand the technology and what's the real world application, what's the problem they're trying to solve. And I think if you do that, you should be safer than if you just follow the crowd, go with with meme coin and a lot of these tokens that fail a lot of the steps that we mentioned in the previous topic.
Very, very comprehensive, Romain. Again, not to tread this space in any light way whatsoever. Now moving on to custody, Anton, you've set up an exchange. Do you want to just take us through how to look at the sort of the exchange side of things? You mentioned before that the sort of the user experience has changed from banking, prime brokers to exchanges originally, now DEXs a little more. Just take us through that journey and what comes with the risk of managing that counterparty risk side of things, whether through a centralized or decentralized exchange.
Yeah, so it's actually fascinating that one of the biggest innovations of the crypto industry, which is decentralization and direct ownership of assets, it actually turns out to be one of the biggest risks as well, in general in crypto, but in particular if you're running a crypto exchange. So for the first time in history, you don't have an intermediary between you and your assets, So because today when I hold my Swiss francs or dollars or euros or dirhams or whatever, there's a bank in between that holds those assets. But in the crypto world, this doesn't exist actually. So if you have a natively issued asset, a cryptocurrency, you can have a wallet where you, through the so-called private keys, the password, you can actually direct access those assets and nobody can be in between of that. And sometimes I give an example to people, like what would be equivalent of that would be that you would have a bank account with a central bank. So if a central bank is the native issuer of the fiat currency, and if you would have directly a bank account with the central bank, that would mean you would not have the counterparty risk of the intermediaries. You would have the counterparty risk with the entity that's issuing the asset, the fiat currency. So for that as well, now for the first time ever, we have in the crypto industry. And now I can tell you that from my experience, exchanges go really to massive efforts that they don't get hacked. Because this is really the biggest loss of confidence and the biggest catastrophe you can have is the crypto exchanges that you get hacked. Or the same goes for a custodian as well, right? And on the other side, what I can tell you, what I have seen is that you would be shocked by how much exchanges are being on attack by experts to try to get hacked. So if you ever, I'm sure a lot of people don't have this experience, but if you go to your CTO and if you tell them how many people are trying to attack us within every given day or period of 24 hours, they will tell you it's an enormous amount of people who are trying to hack in actually. And there, as I mentioned, people are trying to really put massive efforts that this doesn't happen. And I, to be honest, don't see that the risk is now reduced with the spot Bitcoin ETF. I have kind of hinted at that at the beginning, that you have one custodian custodizing for pretty much everybody. So it's Coinbase Custody, who is custodizing for all the spot Bitcoin ETFs, except the one for Fidelity, because Fidelity is a custodian itself, so they can't do their own self-custody. So this is extremely interesting example, actually, where for the first time ever, you can self-custody your assets, so in practice reduce risks, but because actually you have nobody's in between, you actually have bigger risks if you don't know how to mitigate them. So look, I'm a big believer in decentralization, in direct ownership of assets, because it actually clearly reduces risks and provides added value. But I think we are far from that everyday people do that, but also that the experienced asset managers do that as well. And that's why, people like Laser Digital, like Hextrust have a running and successful business. And I anticipate that they're going to have a successful business for many, many more years.
Thank you. Just before we take comments in the chat, Nicola, do you want to provide a perspective on asset security, asset safety, how that's evolving? We know what it looks like in the traditional financial world, your banking assets and what security layers around those from an investor perspective. How's that changing in the crypto space?
There is just one thing that I would like to underline, because it's actually a complicated matter, but some time ago it came out a bit as a scandal that some exchanges in the terms and conditions have these provisions that say that basically when you deposit assets with them, you are not redepositing. They are taking ownership of the assets, and then you have a credit right towards the exchange for them to give you the same amount of assets. And this is a very important thing. In particular, it really comes from banking. Indeed, guys, when you deposit your money into a bank, the word deposit may be misleading because you're actually loaning the money to the bank, which indeed is paying you an interest. Now, this thing with crypto is actually very, very peculiar, because as Anton was saying, all the narrative related to crypto is related to, let's say, you control your own assets and so on. This is very true if you do self-custody. But in the moment in which you do it with a custodian, then you really need to check the terms. And you need to check if this custodian is actually a custodian, so is keeping the assets on custody on your behalf, but you remain the owner of the assets, and the creditors of the custodians can have no rights over those assets. Or if the custodian is actually taking ownership of the assets, and then you are subject to the risk of bankruptcy of this entity and so on. This is something that costed a lot of money to a lot of people in the past, and it's definitely something to which people need to pay attention. And yes, I would like also for the consumers and maybe retail users to be a bit more supported by players in the community, and for more, like, we need more education on this, I think, because people do not really understand the difference.
Thank you, Nicola. Shall we just take the comments and then we can elaborate from there? I think, Anton, probably maybe you or Jeff want to take this one. So I think the question from Abdelila is about Bitcoin dominance, liquidity distribution between BTC and alts, alt season. Sounds like Abdelila, if I get the name right, is looking for a bit of a flavor from the market. Anton, do you want to take this first?
Yeah, so I think that maybe the hidden question here is, if Bitcoin went up so much, what's happening with the altcoins? Or to be specific, why haven't they gone up as well? Or why aren't they hitting their all-time highs and so on? So first, to give a little bit of like a historical perspective, altcoins usually lag about 6 months behind Bitcoin, actually. So kind of, if you want to do a sophisticated analysis, you can do that, but you can just eyeball the charts and you can see they kind of lag between Bitcoin. So as Bitcoin is kind of going up, they're slowly picking up. And there's actually 2 reasons for that. Is first, because a lot of these coins, the way they get liquidity is through venture funding. And usually the VCs, they raise funds from other investors. As Bitcoin kind of picks up, then the investors are more confident to deploy capital into their funds, and then they deploy capital, and then they kind of support the tokens, and kind of liquidity comes in. So that's the first point. The second point is, as Bitcoin and all the major cryptocurrencies go up, people are taking profits off the table, and then redeploying in other coins that are, more volatile, less liquid, and kind of have a higher potential upside. So that's the reason why maybe we have not seen so far yet, this altcoin season, if we can call it like that, is just because the VCs are still raising funds, still deploying capital, it's still in the early days. And likewise, people who are still holding their Bitcoins, they're not deploying it into other altcoins because they see the potential of Bitcoin going up further in the next couple of months. Not that I'm giving any particular financial advice here, but this is in a nutshell kind of what's happening.
Anyone wants to add and complement that answer?
No, I mean, I guess I'd concur. It's the trickle down effect, I guess, in crypto. It's the trickle down in crypto, which is ironically what central bankers argued they would get from pumping up asset markets in TradFi world, that it would trickle down to the economy. But we certainly do see it, and the dominance of Bitcoin is such that, when those profits are taken and it does trickle down and get invested into projects that are much, much smaller in terms of market cap, the moves can be more dramatic. Yep. So still waiting for some of those, although I guess we should note that Ethereum is up sort of 20 to 25% today. So,
yes. Maybe I can add just one thing very quickly, is that the big difference that we have today compared to the previous cycle is that you have huge fragmentation of liquidity among many different blockchains, actually. So, if you just kind of wind back a couple of years back, you had Bitcoin, but there was not really a lot of dApps on Bitcoin, so it was just your digital coin. Then you had Ethereum, and you barely had Solana, which was breaking up all the time. But today, the situation is different. You have all of these chains competing with each other, actually, and trying to capture liquidity. And I think that also maybe that's why also the reason is, like, on many occasions, the ecosystem grows on a specific chain, but it's not real liquidity growth. And I'll give you an example. Now is actually a situation with meme coins on Solana. Most of that capital and that growth that happened is actually between Solana itself. And that's why I think why we have a big challenge today is just liquidity is so difficult to kind of find its way among all of these big blockchains. And on top of that, all these big blockchains are competing for liquidity.
Thank you, Anton. I think we're really up for time now. So perhaps the last closing remarks, maybe from each one of you on the market environment, on risks in general. I think we've covered quite a lot, haven't we?
If I may go first and tackle the legal and regulatory one, I think we have interesting time ahead with this first regulation actually coming into force and becoming applicable during 2024, and we will see the effects on the market. I think personally that the effects will be positive, because they will remove, or at least start removing, a lot of noise and disturb that there is actually in the market, and these could lead to a more sustainable and long-term growth market.
Yeah, agree. Particularly for the institutions, I suppose, banks, for instance. Anton?
Okay, I'll try to wrap it up really. Very excited, for everything that's happening in the crypto industry. We have the retail, we have the hedge funds, we have the professional institutional investors, we have all the rails to, for people to invest into crypto in a safe and secure way. What's the last thing missing, actually? What's the end game happening here? I think, the last step would be actually that we have one of the central banks around the world buying Bitcoin and putting it on the balance sheet, but in the context of de-risking, in a sense of understanding that monetary sovereignty is extremely important, and a Bitcoin is a way out of it, a way to achieve that. So talking about de-risking, in the context of risk, how can we use Bitcoin for monetary sovereignty?
Awesome. Jeff and Romain?
Yeah, okay, well, two very quick points. One on maybe a practical note for navigating the digital asset markets. We talked about wallets and custody. It's worth considering having a multi-wallet approach where you don't engage and interact with DeFi with a wallet that has all of your assets in there. So
Spread your eggs in different baskets.
Yeah, have all of your assets in something that is a bit more more secure, and then you engage with just what you need to spend on that day or need to invest on that day, have that loaded into a wallet where you engage with DeFi. Because there's a lot of scams out there that can trick you and drain your wallet if you sign the wrong transaction. So as for the liquidity in the market overall, we're all beholden. All markets are beholden to the money printers that control the yardstick, which is the US dollar. So the tidal wave of US dollars, if it comes, it's partly dependent on TradFi policymakers sitting around a table deciding how to manage the US dollar.
Romain, please finish it off for us.
Okay, I guess I'll probably come back to what attract most of us to crypto. Beyond what I say, the fact that when we look at white papers and we review protocols, we sometimes astonished by the creativity and the intelligence of some people creating new technology to make the economy more efficient and I wouldn't say fair, but at least try to play their part. And one last thing, when we look at the return distribution of crypto assets, one thing which is very interesting, beyond the fact that they have a pretty above normal kurtosis, which obviously highlight the fact that they are very volatile and very risky assets, they also have positive skewness, which basically means that you will find more large positive moves than negative moves. So to some extent, if you're hanging there, then you should see some of it if it's not a scam and the token doesn't go to zero. So enjoy the journey and hope for the best.
Thank you. And I think we have to close it here. We're slightly over time, but a huge thank you to the Crypto Risk Office, to all of you panelists. I think we've had a lot of richness. We've covered a lot of ground from the markets, the macro picture, the financial risk, the operational risk, the legal side. Hopefully our viewers will have found this helpful, useful, insightful. Give it a like, a comment. You can watch it afterwards in our recording, and I'm sure there'll be more panels to follow in a similar sort of sphere to cover other aspects. Maybe, Jeff, any final words from a Crypto Risk Office perspective?
No, just look, we want to promote good risk management practices across the industry, and we appreciate everybody joining in that journey. So thank you.
Awesome. Fantastic. Thank you, everybody, and see you around.
Thank you, Francesco.
Yes.
Bye-bye.